Okay, everybody, I've got 4:02 on my clock, so I think it's about time to get started. For those of you who I haven't spoken with yet, my name is Daniel Dusina. I'm the Director of Investments here at Blue Chip Partners. I oversee the investment department here at Blue Chip, as well as the overall investment committee. And so very excited to talk a little bit today about our forward-looking views. Just a couple of housekeeping items. If you are interested in asking a question, you should be able to see a question section of the GoToWebinar application on your computer or phone or however you're viewing this. Feel free to throw in questions throughout the discussion. I'm going to give some prepared remarks, but I do want to leave plenty of time at the end to address any questions. Those can be related to the content of this presentation or broadly market oriented. Happy to field and address any questions, comments, concerns, etc. So we've been putting on these webinars for the past 4 or 5 months, and we want to continue to do these on a monthly basis, covering a number of different types of topics, both evergreen and timely. I would say this topic or this webinar is going to be of the variety that's a bit more timely. It aims to outline what we have spoken about in our quarterly edge, which is essentially our forward-looking commentary that we release at the beginning of each quarter. And so more specifically, as we look forward to the next 3, 6, 9 months, we try to identify some themes that we view as most pertinent, unpack them, and express some of our views on them. So today, we have certainly a fair amount to digest in the marketplace, but one of the most driving factors of financial market returns and just the economic landscape overall this year has been the United States dollar. So throughout this presentation, I'll provide some information in terms of what is actually driving the strength in the US dollar relative to other countries' currencies and what that means potentially for US-based corporations going forward. Next, I'll talk a little bit about one of the indicators that we think is very interesting. It's very contrarian in nature. It stems from the American Association of Individual Investors. I'll talk a little bit about where it's been this year and where it is today. And then finally, as we've been doing in past quarters when we put together our outlook, we put together what's called a blue chip radar. And so essentially that just outlines what we view as some potential scenarios for forward returns. In this case, we're actually just going to look at what we view as potential catalysts in the fourth quarter. And those can be catalysts to both the upside and the downside for a more optimistic or a more pessimistic scenario. So jumping into things here, I mentioned the United States dollar and the strength in the dollar relative to other currencies has been an incredibly dominant trend as we've worked through 2022. And so to understand what is driving this strength, it requires first an understanding of monetary policy and how that impacts the value of the currency, but also economic conditions in the country underlying that currency and how that can impact the value of that currency. As it relates to monetary policy, I'd say this is an impact that is incredibly direct. When you look at a central bank, in order to accomplish the objectives that they set out for, really, they have 2 primary tools at their disposal. They can purchase or sell securities in the open market, and they can influence the short-term interest rate. So when you are looking at an economy that needs to be stimulated, such as that which we had from 2008 to 2014, or directly after the pandemic through 2021, you have a central bank, and in our case, the Federal Reserve, that'd be looking to spur growth. And so how would they do that? Well, number one, they would begin rapidly purchasing securities in the open market. That essentially increases the money supply and lowers the yield of financial assets. At the same time, they will be looking to reduce the baseline interest rate, which essentially is an effort to stimulate borrowing, and overall, taken together with the asset purchases, the now lower yield that's offered by this country result in capital outflows as foreign investors can find a much more attractive level of yield elsewhere in the world. Now, the exact opposite is happening today as we're essentially looking to put a lid on growth as the Federal Reserve looks to fight inflation. So what's happening today? Well, we have essentially too much money facing too few things, right? That's exactly what inflation refers to. And so when we look at what's going on today and what has happened this year, the Federal Reserve is looking to sell securities, which reduces the money supply and rapidly increasing interest rates. And so now that we have higher yields offered in the United States today, much more significant from an income perspective than we were at, say, 1 year ago, 2 years ago, or really any point in the last 10, 15 years, we now have foreign investors that are much more attracted to US dollar denominated assets. And so in order to buy US dollar denominated assets, they need the US dollar. And so that has been a significant, call it, driving force behind the strength in the US dollar relative to other currencies, whether it's the British pound or the euro or the yen. And so in the chart on the bottom side of the bottom part of the screen, you can see that there was a very direct impact in terms of what the Fed is doing. You can see that line, the dotted line in red, that shows the effective federal funds rate, which is the interest rate level that the Federal Reserve sets. You can see the correlation between that and the strength in the US dollar. I think it's very direct, and so it's important to understand this is a humongous driving force. But in addition to the monetary policy impact on currency strength, there is a fair amount of emphasis that foreign investors would place on the overall economic strength of the country underlying a currency. And so you can ultimately take it as a vote of confidence that the US economy is on stronger footing relative to other countries, and that's exhibited by this US dollar strength. So certainly we're dealing with inflationary dynamics right now, but that's not necessarily as significant as what we might be seeing in some other parts of the world. For example, the doubling of utility costs in England. I think the US has traditionally been thought of as a safe haven. And again, that's something that is being reflected in the strength of the US dollar this year. Now, that's all well and good, but what does it actually mean going forward? Well, number one, I think that the most important thing for us here is that we need to watch very closely what the impact of this stronger dollar is having on United States corporations. And so while the dollar being strong is advantageous for consumers like you and I that are looking to import goods or travel to other countries, it can have some negative effects on corporate earnings. So just taken as an example, in September 2021, the euro was trading at about a 20% premium to the United States dollar. In September of this year, they were at parity for the first time essentially since the euro was launched in 2002. And so put a different way, if you had a firm that was based in Europe that was looking to purchase, say, a $1 million piece of equipment from a domestic firm, the price that they're paying this year relative to last year essentially resulted in a 15% markup just because of the action in the foreign exchange rate. And so I think that there is certainly, as we progress through this, some need to watch closely to see if firms with foreign exposure are seeing clients pull back at all. But also there can be a translation effect on financial statements, which is, again, the chart on the bottom of the screen will show you that translation effect for firms like Meta Platforms, Alphabet, and Microsoft are experiencing that in a significant way due to the fact that they do have sizable international exposure. Now, it's important to note that it shouldn't just be taken in absolute terms. Many of the firms that we've looked at, and I would say those that we are interested in, have an ability to offset that translation effect and the impact of the foreign exchange rates from continuing operations and focusing on their core business and growing within that business. I think a good example of that is Pepsi. We just saw them report earnings 2 days ago, and I'm happy to go into more detail on why I think that was a favorable outcome later. So in addition to the US dollar, something that we've been watching pretty closely, it's a contrarian indicator. It's a survey that is put forth by the American Association of Individual Investors. And it is a survey that is released each week that polls individual investors and asks them a pretty simple question. It asks them, what do you think the aspect for, or the conditions for market returns over the next 6 months will be? And the options that they can respond as are bullish, optimistic, bearish, pessimistic, or neutral. And what we have found is that when times of investors being overly optimistic in this survey, the forward returns are actually not as attractive. And then when investors in this survey are overly pessimistic, the forward returns are actually pretty compelling. And this is based on history and data that goes back to 1988. And so what we've pegged as a, call it key level, is that when bearish respondents outnumber bullish respondents by 35 points, and that's what you can see as exhibited by the green line in the chart on the bottom portion of the slide, that generally serves as a fairly nice inflection point. It essentially is saying that the broader market has gotten too negative, and based on the data that we have going back to 1988 since the survey was launched, the forward 12-month returns for the S&P 500 index are significantly positive. Again, this is just an average. That's not to say that it happened every time. It did happen in 12 of 13 instances going back through that 40-year track record nearly. But again, this is just something that we look at because it's important not to just follow the crowd. Certainly we have concerns that we are weighing right now, but at the same time, we're able to find some fairly attractive opportunities that are, call it, on sale with very healthy fundamentals that we've been wanting to buy on sale for many years. So this is something we watch fairly closely. And although sentiment is not the be-all, end-all, tell-all aspect of financial markets, we think it's very, very compelling and important to keep a pulse on. And then finally, as we look at the fourth quarter here, we have outlined what I view as three key catalysts. The first is related to the Federal Reserve. The second is related to the overall economy. And the third is related to businesses. These are catalysts depending on how they're developing in the fourth quarter. I think they can dramatically influence an outcome in financial market returns. And so starting off on the pessimistic side, in a bear case, we very well could see the Federal Reserve hike the U.S. into an economic recession. The Federal Reserve has voiced a commitment to do whatever it takes to manage inflation. We're seeing that with aggressive monetary policy and rapidly rising interest rates. And they are of the opinion, as it stands today, that their goal is to manage inflation. It doesn't really matter right now what that does to the overall impact on GDP or economic growth, but it remains to be seen where the terminal rate will be and what they are comfortable with from an inflationary perspective. So that's certainly a possibility, as we've seen in cycles through past history. Secondly, as we look at the overall economy, we have seen a bit more softness in consumer spending over the last few months. I wouldn't say to a concerning degree, but should this continue, and in tandem, should we have consumer balance sheets start to deteriorate a little bit, that would certainly be very detrimental to economic growth, as consumer spending represents a very large portion of domestic economic growth. So with that higher inflation and fairly tight financial conditions, you might start to see some of the individuals throughout the country pull back and ultimately, pull a floor out from underneath the domestic-based corporations. And then finally, when we look at the business environment through the fourth quarter, one of the things that we have been looking for very closely over the past 3 quarters now is the impact of these price increases around the US on actual profitability. We've been looking for margin compression. We haven't necessarily seen it in a very broad sweeping way yet, but certainly that remains top of mind today. So have the tighter financial conditions and potentially lower levels and softer overall consumer spending, have these impacted corporations in a meaningful way? I think that if you get a worse than expected outcome, broadly speaking, as we get financial results over the coming months, that would be fairly, I would say, detrimental to equity market returns. But at the same time, I think that the outcome that is being priced in right now is a little bit overly pessimistic. Nonetheless, certainly a catalyst worth noting. These same 3 catalysts, they could have positive outcomes as well. I would say the Federal Reserve, starting there, very much a possibility that they ultimately become satisfied with the trajectory of inflation. Based on the print today, that doesn't appear overly likely, as we just got another fairly hot print on the CPI. But there is potential as we work through the next couple of months and the Fed digests what the level of interest rates and the overall financial tightening has done in terms of managing inflation. I do still think some of that inflation will continue to moderate naturally, especially as we have less of a floor placed under some of the significant price increases from things like gasoline. But again, this is something that I probably would say is the largest catalyst for financial market performance right now, and that's the Federal Reserve. Secondly, consumer spending is softening a little bit, but we really haven't seen major cracks. Certainly, the whole household capitalization across the domestic parts of the economy, I would say, has held up fairly well. And there is certainly prospects for that to continue. That spending and continued financial capitalization at the household level would certainly support continued growth and demand at corporations. And then another metric that I would say that supports a bull case from an economic perspective is the fact that when you look at personal disposable income relative to the level of debt service payments, this is generally a good indicator in terms of the health of consumer spending. It's still very much at average levels going back through history. And so that tells us that there is a fair degree of ability of consumers to continue spending on what they want to, not just what they have to. And then finally, if this does end up being the case, that certainly is a tailwind for corporations based domestically. We have seen corporations be very dynamic. We saw it through the pandemic, and we're seeing it now in terms of their ability to exhibit newer financial controls and ultimately just to work around and focus on core businesses in order to offset some of the macroeconomic headwinds that we're seeing today. So you got consumers that still have a reasonable capacity to spend, and although the backdrop might not be as, I would say, compelling as it was, a year ago, just based on the level of and the persistence of inflation that we've seen, there still are a number of avenues that corporations can travel down in order to maintain their margins and ultimately maintain productivity in the stock market as well. So those are the prepared remarks I have for today. I'm going to pause right now and see if we've gotten any questions come in that I might be able to address. So as I see it, I don't have any questions that have come in quite yet. So I'm just going to take a couple of minutes and talk through, where we are finding opportunities in today's market. Certainly there's a lot to unpack as it pertains to how markets have moved this year. But at the end of the day, I mentioned this earlier and alluded to it in the sense that there's a lot of firms in the US from an equity market perspective that are fundamentally unchanged today. And you're essentially able to buy them at a steep discount, not just to their price at the beginning of this year, but even to their valuations on average over the last 5 years. So when we look at the market backdrop and the volatility, we actually utilize what's called our Lane Assist market monitor. That's something we built internally, and it essentially serves as an initial guidepost in terms of where we should be looking for our initial fishing pond for opportunities in markets today. And based on where we have volatility and the overall trend of economic growth, it's actually right now the cyclical side of the equation. So that includes firms in technology, in energy, in the financial sector, and so on. So the more economically sensitive areas of the market, which is a little bit counterintuitive relative to what we see going on today from an economic perspective. But this has been back tested back through 20 plus years, and that just serves as our initial fishing pond. So within that, we've found a fairly large amount of opportunity, I would say, when we look at valuations and the quality of businesses and technology. There are a number of firms that I would say have glide paths to continued profitability regardless of, I would say, the economic outcome. So, information technology has traditionally been bucketed as a cyclical part of the market, but really it appears more defensive, and we've been vocal about this over the past couple of years. And so really just looking for firms that can provide that opportunity set for attractive upside participation, not looking to shoot the lights out, but really focused on capital resiliency. So that includes firms with good balance sheets, really good capacity for dividend growth in the future, and ultimately just good management teams that are going to be able to continue to emphasize efficiency in their businesses. Another thing, when I mentioned the United States dollar and the impact that it has, this is not always an explicit input to our analysis, but in times like this, I think it's a healthy exercise to make sure we understand how we're positioned. And when we look across the various sectors, something that stood out to me, I don't believe I'm allowed to name specific security names just for compliance purposes. So hopefully I get some brownie points from our head of compliance here. But there's a specific subset in the industrial sector where our decision to invest in one logistics company relative to another is further supported by the fact that the impact from foreign exchange rates has been significantly less and is anticipated to be significantly less going forward. So that type of healthy analysis, I think, is very important when I talk about the importance for selectivity today. And you will see us do exercises like that on a very frequent basis. So really what it's all about right now is just making sure you know what you own and making sure that you're positioned in a way that emphasizes quality. And given the fact that you are now able to obtain a more meaningful level of income throughout the fixed income space, I think some selectivity is required there as well. But there are more options on the table. And it's important to note too that, it's not all doom and gloom, but certainly some risks to manage throughout the remainder of this quarter. So I did get a couple of questions come in. I'm going to see if I can unpack them. Are we taking any precautionary steps about Ukraine and Russia? I would say that when the conflict first escalated back in the end of February and through March, we did do a bit of a robust analysis on the companies within our core model and their exposure to Russia. We put together a research pack that essentially outlined the actions that those companies had taken, and we then formulated an opinion on whether or not we thought it would be overly detrimental to the stock performance of those companies or not. I think a good example of this would be McDonald's. So they enacted a policy to fully remove themselves from Russia, and ultimately we decided to maintain exposure. And certainly that had an impact, but it was not overly detrimental to the performance of not just the stock, but the business overall. Another example would be a tobacco firm, Philip Morris International, same idea there, removing entirely from Russia. The impact there was a bit more significant, but again, offset by some of the more new generation technologies that they are pursuing right now. And so I think investors are giving credit where credit is due for items like that. We're certainly not geopolitical experts by any stretch of the imagination, but really we're just trying to find, dislocations and avoid any potential impact from negative business developments, such as, removing a very key part of the business. So we have one more question. With the hot CPI print today, that's referring to inflation, do you think it is likely that the Fed will be adjusting the terminal rate estimate higher above 5%? So as we look at the Federal Reserve, they have been, I would say, a bit unpredictable through this cycle, because when we look back this time last year, inflation was already running incredibly hot, and they failed to act upon it because they were of the opinion that the labor market had not fully healed yet. Clearly, they were a bit late to the party there, and what you're seeing now throughout this year and through the next few months is that they're playing catch up. And so as we see continued inflationary pressures, they will continue to keep their foot on the gas in terms of trying to put a lid on the inflationary pressures and ultimately raising interest rates. In terms of what today did, it was a inflation print that was modestly above expectations. I'm not sure that the terminal rate gets adjusted anything more severe. I don't think it will tick up above 5%, but this is again, the Fed has been pretty unpredictable through this cycle, so it's hard to place bets on this type of thing. But I think what you look at is that right now, where the terminal rate is at, as implied by market prices, is actually below what the Federal Reserve has put forth. So I think that there is room for it to move upwards, but I don't think there's a lot of room that it will be extremely revised upwards. It's also worth noting that, this hasn't really been talked about a lot, but from a debt perspective, the level of interest rates does impact the level of debt service that a government has to put forth on obligations. And so, given the massive debt load that we have here in the US, I wouldn't be surprised if there was some pressure on the Federal Reserve to constrain their aggressive nature. Not saying this is going to happen overnight, but I think that's a factor that's worth considering. And also, when we think about higher interest rates, that certainly has an inverse impact on bond prices. It certainly has an impact on financial statements for equities. But at the same time, we have seen a lot of companies be able to manage through this. Again, we've been watching for margin compression, and we haven't seen it in a broad sweeping way. We've seen it some places, and that's why selectivity is, again, paramount here. But I think ultimately what the Federal Reserve does is, once they see economic growth be severely impacted and they see some natural moderation in inflation, regardless of the level of CPI, I think you'll start to see them take a little bit of an easier stance. Well, we're coming up to about 4:30, and I don't see any other questions right now. So if you do have any follow-up questions, please feel free to email your Blue Chip advisor or myself or our broader mailboxes. And I really appreciate you all joining for the conversation today. Enjoyed the engagement and enjoyed the discussion. I hope you guys did too. So stay up to date with us through our various mediums, whether it's on our blog, through our website, through LinkedIn, where we post a fair amount of meaningful and compelling information. And if not, I will see you next month. Thank you all very much for joining.